Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report about Arbor Realty Trust, and let me tell you, it's about as exciting as watching paint dry. Unless you're into complex financial deals involving real estate, then buckle up. Before we get started, if you are into that kind of stuff, be sure to subscribe and hit the bell icon for more corporate deep dives. Also consider joining our Discord server from the link below. This report is about how Arbor Realty Trust created a financial structure involving a lot of loans, a bunch of different types of notes or debt, and a way to manage it all. It's called a securitization, and the details are pretty important for understanding what Arbor is up to. The key date here is May 30, 25. That's when all of this activity happened. So Arbor Realty Trust has a subsidiary, which is like a smaller company controlled by the main one that issued a whole lot of notes. These notes are basically IOUs promising to pay back money to investors. The total amount is huge, over $682 million of investment grade notes, which means they're considered relatively safe, and almost $120 million of Verismith's chairman, which made you considered relatively safe. And almost $100, which means they're considered relatively safe, and almost $120 million of lower rated notes, which are riskier. These notes weren't sold to the general public. They were sold in a private placement. Think of it like a secret sale, only open to certain investors. Also, Arbor's own subsidiary bought the lower rated notes. All of this is happening under something called an indenture, which is a fancy word for a legal agreement that spells out all the terms of the deal. What's Arbor planning to do with all the money they get from selling these notes? Well, mostly they are going to pay off existing debts, cover the costs of putting this whole deal together, and have some left over to loan out in the future. Now let's dive deeper. These notes are split into 11 different classes, each with its own level of risk and return. Some are considered senior, meaning they get paid back first, while others are lower down the pecking order. The first Class A notes are considered the safest. Then you have other classes like A1R, ASBC, D, E, F, G, and income notes. It's like a financial layer cake, with each slice having a different flavor and level of risk. A big piece of this puzzle is that Arbor itself or its subsidiaries bought some of these notes, especially the riskier ones. These notes are secured by a pool of real estate related assets. That means if the notes aren't paid back, the investors can take ownership of these assets. As of May 30, that pool of assets was worth over $583 million. These assets are mostly construction and bridge loans, which are used to finance build-to-rent properties. To manage all of these assets, Arbor has a deal with a company called Arbor Realty Collateral Management. They'll give advice on how to handle the loans and investments that are backing these notes. Interestingly, the collateral manager is doing this without getting paid a management fee. That's quite generous. Arbor also has a deal with another company to service the loans. Servicing basically means collecting payments and managing the loans on a day-to-day basis. Similar to the collateral manager, the servicer is waiving its service fee but will still get reimbursed for costs. It is important to know that if the money from the real estate assets isn't enough to pay back the notes, the company that issued the notes, the issue has no further obligation. The interest rate on these notes is a bit complicated. It's a floating rate, meaning it can go up or down, and it's based on something called term SOFR, plus an additional 2.48%. These notes are set to mature or be fully paid off on January 23rd, 2041. That's a long time away. However, the company expects that the notes will be paid off much sooner, somewhere between 369 and 4.81 years. There's also a clause that allows the company to call back the notes, meaning they can pay them off early if the total amount of notes outstanding falls to 10% or less of the original amount. The notes can be forced to be redeemed or paid off early if certain financial tests aren't met or if the ratings assigned to the notes change. Arbor is required to keep a certain amount of the riskiest notes called income notes to show they have skin in the game. This is part of a regulation called Regulation RA, designed to prevent companies from creating risky investments and then passing all the risk on to others. There are a few special events that could trigger a default on these notes. One is if the company that issued the notes, the issuer, loses its special tax status as a real estate investment trust or REIT. Finally, Arbor put out a press release to announce that this whole deal went through. It's basically a way to let everyone know what they've been up to. The press release basically summarizes all the key points we've already discussed. Tapting, so what's the big picture here? Arbor Realty Trust has created a complex financial structure to raise money, pay off debts, and fund future lending. It involves a lot of different layers of risk and reward, and Arbor itself is heavily invested in the deal. Now, let's step back and analyze this situation. Arbor is clearly in the business of managing risk and reward. They're taking on the risk of lending to build-to-rent projects, packaging those loans into securities, and selling them off to investors. They are keeping a portion of the riskiest securities. This could be a strength if those loans perform well, but it's definitely a weakness if those loans start to go bad. One notable risk is the complexity of the structure. With so many different classes of notes and so many different companies involved, it can be hard to understand exactly where the risks and rewards lie. This can make it difficult for investors to assess the true value of these securities. Another risk is the reliance on build-to-rent properties. If the market for rental housing weakens or if interest rates rise, these projects could run into trouble, which would impact the value of the securities. On the other hand, there's also an opportunity here. If the build-to-rent market continues to grow, and if Arbor can manage these loans effectively, this securitization could be a very profitable move. In conclusion, this deal is a double-edged sword. It could be a great way for Arbor to raise capital and grow their business, but it also comes with significant risks. Investors need to understand those risks before jumping in. Alright, that's our breakdown of Arbor Realty Trust's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.